Today we're going to be covering all the tax advantages of real estate, and I know there's plenty of videos covering this topic, but we're going to try to strike the right balance between a simplified explanation so it's easy to comprehend even for beginners, while at the same time covering a level of detail so that we actually walk away fully understanding and learning this topic rather than just kind of glossing over the subject altogether. And while some of these tax advantages apply to any homeowner, the reality is we're going to be covering the ones that focus more on rental income, right? That's the one that most people are interested in because passive income, easy money, that's kind of the belief anyways. But the reality is things aren't always as it seems, especially when it comes to taxes. And I want to lead with this one key important point, which is when it comes to tax advantages of real estate, as someone who has actually worked in the auditing industry, most people are kind of surprised to learn that when it comes to taxes, things aren't always black and white as one would expect. When it comes to laws regarding taxes, the reality is not as finite as, let's say, math, where it's 1 + 1 always equals 2. When it comes to taxes, there's actually a little bit of vagueness and some room for interpretation there. And when it comes to taxes as well, most people, their knowledge of taxes is usually either second-hand or even third-hand knowledge of taxes, right? They're hearing vague advice from something they heard on the radio or some other friend that they heard when they had a water cooler talk about taxes and how to avoid that. The reality is most of that knowledge is actually a little bit misleading. Classic example of this is when people think of a write-off. For whatever reason, people think that the business doesn't have to pay for that at all. Or some people are smart enough to know that, oh, well, a write-off just means you're just saving on those taxes because you're reducing your income. And I'm smart enough to know that if I have an LLC, that means I can basically write off, meal expense and kind of classify it as entertainment. And I've never been audited, so I must be doing this correctly. But the reality is you can get audited several years after the fact. So I definitely caution people from getting their tax advice, let's say from TikTok or even this video. The reality is you want to do your own research, and it can seem a little bit intimidating at first. But, and this is coming from somebody who has worked in the auditing industry and has worked with accountants. The reality is some of these accountants are even just Googling these questions themselves, and there's tax forms out there. So I'd actually encourage people to kind of go directly to the source, go to these same forms that accountants are using, because there's no guarantee that even if you just hire an accountant, there's no guarantee that you're not going to get audited. The reality is it gives you some level of protection, but if you get audited, even if you do have professional tax advice, you still are on the hook. Whether or not you had an accountant or not doesn't really matter. The reality is you're still on the hook for the taxes, and you're going to have to hire a lawyer that understands taxes well and have to fight this, and you're still on the hook for that expense, right? You're going to have to pay that lawyer as well. So I always encourage people to kind of do the first-hand knowledge themselves. Go directly to the source, read some of this tax law. It seems intimidating at first, but it's really not that difficult. That being said, I will do my best to cover the major tax advantages of rental properties in this video so that way you understand it, because it's my belief when it comes to personal finance, it really comes down to learning specific topics in depth to really improve your financial position and increase that wealth. Sure, spend less and save more. That vague advice can help you in essence, but the reality is it really comes down to the specific topics on really learning about personal finance. If you appreciate that all, please consider subscribing to the channel and let me know down below any topics you may be interested in. All I ask in return is just hit that like button. So the first major tax advantage I want to cover is mortgage interest expense. And really when we're talking about any of these tax advantages, really what we mean here is ways to basically on paper reduce your taxable income so that way you're not paying taxes on the full amount. So let's say in reality you're making $100,000. Whether or not you take these tax advantages, you're still making $100,000. But let's say on paper you can reduce that income to $70,000. You're still getting paid $100,000, but on paper, as far as the IRS is concerned, your taxable income is reduced to $70,000. So now that $30,000, which you still got paid, you no longer have to pay taxes on. That's kind of in essence how all these tax advantages work. I'm kind of simplifying a little bit here, but in essence, that's how it works. One of the reasons I lead with mortgage interest expense as being a key tax advantage is because when it comes to rental properties, one of the key variables they're concerned about is the interest rate being charged on mortgages. And just kind of a simplified example, if I'm looking at a property and it would be profitable in the long term and as well as generating cash flow in the short term at a 5% interest rate, but let's say that same property was at 10% and it was no longer really that great of a decision. What if there was a way to kind of effectively, or in essence, basically reduce that 10% interest rate that I'm being charged down to 8%? With mortgage interest, it can be used as a tax deduction, meaning it's reducing your taxable income. This doesn't mean that you don't necessarily have to pay that mortgage interest anymore. It's not like the business just magically writes it off and it goes away. The reality is you still have to pay it, but you are saving because you're reducing your taxable income and saving on those taxes. I'm going to throw up a simplified example on the screen, but just bear with me. Let's say that my normal income is $50,000, but I paid $10,000 in interest expense. Then my taxable income is actually reduced to $40,000, meaning that $10,000 difference, I no longer have to pay taxes on that final $10,000. I still get paid the full $50,000, but on paper, I'm only making $40,000. So if I ordinarily get taxed 25%, then I just saved about $2,500 on those taxes. So when you think about the interest rates and the interest you're paying, you can somewhat look at it reduced by the amount you saved on your taxes. So let's say that I was charged 10% over the course of a year on a $100,000 loan. So I paid $10,000 in interest, but I saved $2,500 when I filed my taxes, depending on when and how you did that. So in a way, you can kind of think about it as I only paid $7,500 in taxes, therefore reducing the effective interest rate that I was charged. So really, it's more like I was charged 7.5%. But in the end, I'm ultimately still paying the $10,000 in interest, but it's just kind of in essence or effectively my interest rate that I'm being charged is more like 7.5%. And this can be a little bit confusing for some people to understand, so I try to make it as simplified as possible, but if you have any questions about it, feel free to ask and comment down below. The next major tax advantage is being able to use depreciation expense. And most people, when you think about depreciation, you think about a car losing value over time, but when it comes to a home, you're actually ending up saving a lot, especially on those taxes. Now, you can still have a home increase in value over time, but the reality is on paper, because of depreciation, it's losing value and reducing your taxable income. So if there's one key thing I want people to take away when it comes to depreciation, just because you plan on selling a home 10, 20 years down the road and turning a profit, selling it for more than what you currently bought it for, that doesn't mean that you can't use depreciation to your advantage and kind of on paper lose value on that home over time. When it comes to depreciation expense and using it to your advantage, there are rules you have to kind of keep in mind, and there are special sets of rules depending on the type of property you own. For example, commercial real estate can have a typical lifespan of 39 years versus residential rental properties have a typical lifespan of 27 and a half years. But the reality is sometimes I can kind of feel a little bit overwhelming. There's different depreciation methods I'm reading about there. There's different lifespans, there's different things and different rules. It can feel a little bit overwhelming. But what I encourage most people to just at least try out a year or two is to use a tax software rather than just going straight to a tax professional. Because I feel like a lot of people have this misconception as far as using a tax professional is going to be your end all be all and that they're going to have all the answers. The reality is in a lot of cases, especially if you're kind of cheaping out on that tax professional, the reality is they're just Googling all the different questions out there anyways, or they're using a software on their end. So why not just cut out the middleman in a way? If you are going to use a tax professional, I definitely would encourage you to pay the price, right? You get what you pay for. So if you're going to use a tax professional, definitely make sure you pay a good tax professional. But always keep in mind that at the end of the day, in most cases, you're going to be the one that's liable for those taxes if something kind of ends up happening wrong. I can't tell you how many times I see this kind of sad story of a tax professional making a mistake, and then in the end, the individual actually has to hire a lawyer to kind of fight the taxes that they owe and end up paying thousands of dollars to that lawyer. And so they did the right thing, they hired the right tax professional, but they ended up still having to pay a big price. Now, depreciation expense basically works the same idea and concept as far as mortgage interest expense. You're reducing that taxable income. If you have a $100,000 asset or property that you're depreciating over 10 years, that means that's $10,000 that you're reducing your taxable income each year. That's a simplified example once again. So when it comes to depreciation expense, there's kind of a couple of key questions you need to be asking yourself and that you really need to fully understand. The first being, is this something that's actually going to lose value over time? For example, land doesn't really lose value. In fact, in most cases, it usually appreciates in value. So you don't really depreciate land, but when you buy a property or buy a home, really what happens is when you buy a $200,000 home, you're really buying a $160,000 house on a $40,000 property. Obviously, that can play out a couple of different ways, so you really want to make sure you fully understand how much actually should be allocated to the land, and that's actually the purchase price of the land versus the actual purchase price of the home. And sometimes you can rely on a tax assessment to kind of gauge that value. But the reality is you could have like a barn on, 10 acres versus, a really nice luxury mansion on a small little lot of land. They can end up being the same price, but for very different reasons. So it's really critical you figure out and accurately decide and allocate what the actual value of the home is going to be, so that way you can depreciate only that over time. The other thing you need to be asking yourself, is this a tangible asset, or is this just something that has a typical operating expense? For example, if I have to replace a door because it has a hole in it, that's typically going to be just an expense and normal operating expense. But if it's something like I have to replace the furnace and AC and all the HVAC throughout the house, and it's going to cost $20,000, that's actually something that should be classified as an asset and should be depreciated over time. And it's really critical that you understand this difference, because in a lot of cases, this is typically a place where a lot of people get audited, is because they kind of misclassify it one way or another. They either write off the whole entire AC and furnace replacement, that $20,000, as an expense in 1 year. So, from a accounting perspective, all of a sudden you have this $20,000 loss or a $20,000 expense that you're reducing your income, even though typically it should have been more like $1,000, because you would have been depreciating that replacement over time. The last question you need to really be asking yourself is, when is it actually in use? Because by the time it's in use, that's actually when you should be depreciating it. So in a typical normal construction, if I build a home and I start renting it out, as soon as that home is done and built and I'm trying to find a tenant, I should be depreciating it over time, because that makes sense. But let's say I have a duplex or a multifamily home where there's 4 different units that I'm trying to rent out, but only one is actually fully constructed and the other 3 are still under construction. Really, you should be depreciating that one unit because it's already completed and it's in use. The other 3 shouldn't be being depreciated yet because it's not even being used yet. But some people make the mistake of waiting until all 4 units are completed. But what if it takes, 3 or 4 years for the 4th unit to actually be fully completed, versus the first one has actually been rented out for, several years at that point? So that's something that you really need to understand, is when is it actually in use? And in some cases, you may have to classify each unit as its own separate asset. And because the first 2 went a little long and probably put you to sleep, this one's going to be a little bit quicker. The next tax advantage is property taxes, which basically works the exact same way as mortgage interest expense, basically just reducing your taxable income. But if you made it this far in the video, I just wanted to take a moment and just say I really appreciate your time, and I hope you're getting a little bit of value out of this video. Now, here are a few more unique tax advantages that don't typically come to mind. The first being property damage to your home, is in any kind of type of repairs really. But when you think about a typical home, if your fence were just to suddenly collapse, the reality is you still have to pay that, and you don't necessarily have any tax savings that you can benefit from. But with the rental property, you'll still have to pay the repair on the fence, but at least you will have some tax savings down the road. So it can kind of make, biting that bullet slightly less painful, because, yes, I'm paying $10,000 to replace the fence, but I'm going to save on taxes, $2,000 on taxes down the road. So it makes it a little bit easier of a pill to swallow when you're actually making that repair. Now, another tax deduction that I don't necessarily see a lot of people talk about when they talk about rental properties, and it actually does depend on how it's classified, is travel expense. So when you think about traveling to and from a tenant, in some cases you can actually deduct that travel expense. If I have a rental property that's just down the street and, that gas and mileage, that's typically not something that's going to be able to be tax deductible. But if, let's say, I have 10 properties in a certain state that I was living in, I bought all these properties and then I moved to a different state, but now I have to fly, or I have to at least drive back and forth to that area to be able to service all my tenants or to be able to service these properties, that actually may be able to be classified as a tax deductible travel expense. Another unique tax deduction that doesn't typically come to mind is legal fees and insurance. Obviously, you want that insurance, so just in case someone trips on your property and tries to sue you, or if you have to evict someone and hire a lawyer, that's, lawyers are already expensive enough, so having that tax savings can help quite a bit. Another tax deductible expense when it comes to rental properties is advertising costs, and this is an area where I see some people get a little bit too creative here. here. Like I said before, when it comes to tax law, it's not necessarily so, black and white. There is this little bit of vagueness involved in there. And some people like to kind of skirt this gray area in terms of, whether or not something is actually an advertising expense. So they'll slap a sign on a car and say the whole car, the $100,000 Ferrari is, it's an advertising expense. Whether or not that's actually justified, just because they haven't got audited over the past couple of years, doesn't necessarily mean what they're doing is actually justified. So that's definitely kind of like this risk reward type situation. Whether or not you want to classify something as an advertising expense or not, definitely those more reasonable advertising expenses like signage that kind of, I have a house at this location and I'm renting for this much. That's definitely something that's justifiable that I wouldn't worry too much about. It's when you kind of push into those kind of gray areas that, that's kind of on you whether or not you want to do that. Another more unique one that typically doesn't come to mind, and it kind of depends on the situation, is utility expense. So it kind of depends on how you rent to the tenant. If you're renting to a tenant and they're paying the utility bills and all that stuff, then obviously you can't use that as your own tax deductions because you're not the one who paid for it. But in some circumstances, let's say you're renting out a duplex and you only get one utility bill, and so you end up just kind of simplifying the process for both tenants, and you just end up charging them both a flat fee of $1,000. They don't have to pay for utilities. In that case, it may be appropriate for you to write off those utilities expense as a tax deduction and reduce that taxable income. Like I said, there's a lot of bit of gray area on here, and it kind of depends on the situation here, but it's definitely something worth kind of keeping in mind. And plus on top of that, when it comes to the tax savings on these utilities, even on a $100 utility bill, the tax savings is really not going to be that much, but it's definitely something worth mentioning. Now, I do want to just end this video with a couple of words of caution, especially when it comes to taxes. Once again, as someone who actually worked in auditing in that industry, one of the big words of caution I would give, at least to start off with, is just document everything. Make sure you have receipts and actually back up those receipts as well. Because the reality is when it comes to audits, it's not necessarily a quick and easy process. And in some cases, you could be like, well, I did mail you those receipts, or I did provide the documentation, a year ago, but now I've lost it. Well, unfortunately, that's going to be on you. Whether it's even you have a valid excuse or not on why you lost something, maybe, your house got flooded or something like that. The reality is if you can't provide that documentation, that's going to be on you, and they're going to have to assume the worst. So definitely make sure you do yourself a favor, keep track of everything, and also do yourself a favor and back up everything. The next word of caution is that when it comes to taking tax advantages and using it to your benefit, the more tax advantages you use, the higher risk you have in terms of getting audited. It increases exponentially. So, but at the same time, if you take these tax advantages that really don't amount to much, you save $5 on taxes, is that really worth your time or not? So it's kind of, like I said, this risk reward type situation. You want to take advantage of these huge tax savings on these bigger tax advantages, but at the same time, if you get audited once and you pay a tax lawyer and you're going to pay so much money, maybe you're going to end up paying so much that it's not really worth taking those tax advantages. So that's definitely something you want to consider. And plus, on top of that, the time and stress involved if you actually have to go through an audit. Because let me tell you, when I work with these different people, it's a stressful process and it's not necessarily something you want to go through. The last word of caution is when it comes to rental properties, tax advantages tend to attract a lot of people, but it shouldn't be the reason on why a rental property is profitable or not. It should be profitable regardless. Sure, with multi-billionaires or multi-billion-dollar companies, they can save hundreds and even millions of dollars on taxes by taking the proper tax deductions. But when it comes to dealing with like 3 or even 10 rental properties, it really shouldn't be the reason why you're profitable or not. So really do your homework beforehand and make sure that's going to be profitable decisions regardless of the tax advantages that you're going to use or not, because tax code can always change down the road versus an actual profitable business should remain profitable. At the end of the day, there's a lot of people out there that they hear taxes, they kind of get scared away. So I hope I simplified this video enough while maintaining that level of detail. If you appreciate this at all or appreciate these types of videos covering these topics in depth enough when it comes to personal finance, whether it be real estate or business, please consider subscribing to the channel. If there's a future video you're interested in, like I said earlier, feel free to comment down below. And as always, appreciate you, and I hope to see you in the next one.